get started. Uh, it's my great pleasure to introduce Jonathan Eaton. We've known each other for quite a long time, and it's been my pleasure to know Jonathan for a long time. I think this session is going to have two of the most interesting and influential people doing trade research, and so for most of you, you probably know who these people are and know all about them. For those of you who don't, you're in for a real treat. So what we're going to do is we'll have, since we have two papers, they're going to be 40 minutes apiece, and we'll hopefully have a little time for questions at the end of each paper. Okay, so.
Thank you very much, Ray. I appreciate your coming. I realize we're competing with Shanghai Shea, so this is a real pleasure to have you here. This is a paper that's joint with Sam Cordham, who's here, Brent Nyman and John Romales, and you can see their affiliations. It was work we started at the beginning of the recession, and there was this remarkable event that happened. The world trade fell by 20% in a very short period of time. And it was relative to GDP that it fell. And this was, I think, a well-known phenomenon. Since we've been working on this, time has passed, as often happens. And one interesting thing that's probably less well-known is that the trade recovery has been quite partial. This is the basic picture that this research is trying to understand. This is trade, world trade, relative to GDP, merchandise trade, going back to 2000. And you can see that except for the recession here in the beginning of the 2000s, there's this rapid growth of trade. And here you can see how it really plummeted in a very short amount of time. Remember, this is relative to GDP. And everything was falling in this period, but the point is the trade was falling a lot relative to world GDP. You can see it recovered, not as quickly as it fell, although that recovery is starting to look a little wan. This is just to show that it was a worldwide phenomenon. These are four of the world's largest economies. And again, trade to the GDP of those countries is here. And you can see in each of these countries, there's been this similar phenomenon, Germany, Japan, China. So an interesting question is what happened. And this isn't the first paper on this. There was a big literature that grew out of this phenomenon, which I'm not going to take the time to go through. But one kind of explanation was that trade simply got more difficult, perhaps because there was more protectionism in the world. Or maybe it had to do with trade credit. There was a financial crisis at this time. A lot of countries were relying on financial institutions to finance their trade, and consequently, the financial crisis led to that trade credit drying up. Can people hear me? I realize there's a mic here. Should I be using it? It's okay. Okay, good. I have a loud voice. And another type of explanation was that it was a compositional effect. The types of goods that were traded collapsed much more than the types of goods that are less traded. And part of this exercise is going to be seeing to what extent were these two different forces at play during the recession, and what forces were at play during this not very complete recovery that we've observed. Sort of some preliminary questions before we get to the analysis itself. There is some interesting data that I think is kind of suggestive of what was going on. For instance, the question is this cyclicality of trade relative to GDP something that's specific to the recession or not? And this was one of the first things we looked at. Of course, the recession in 2008, 2009 was one of the most severe since the Depression, and we don't have very good data going back that far. So what we did is, for a set of countries, we graphed the change in real GDP year to year, but by quarters, against a change in imports to GDP. And one of the things to note is there is this procyclicality of trade, at least pronounced in the US and Germany, but less so in Japan and China. And for the US and Germany, it looks like the recession, what happened in the recession wasn't that surprising given past trends. Of course, trade to GDP fell, but GDP growth was about the lowest it had been in a very long time. On the other hand, we can see with Japan and Asia, this procyclicality is not nearly that pronounced. And the recession does seem to be something out of the ordinary. Now, one of the things that that people immediately, quite quickly looked at is trade is dominated by manufacturers. Especially merchandise trade, which is what we're looking at. But manufacturers are no longer dominating GDP. Did a similar exercise looking at the manufacturing share of GDP and saw something quite similar across all four of these economies. That the manufacturing share of GDP is quite pro-cyclical, and what happened during the recession was not that much out of the ordinary, given the decline in growth. As you'll see when we go to the analysis, we're going to separate trade in durables from trade in semi-durable manufactures. And this looks at the change in the production and the change in trade across a set of countries during the recession. This is looking at the ratio in quarter 2 of 2009 to quarter 3 of 2008. That's the period when things really plummeted in terms of trade. And here you can see what we're seeing in the aggregate was true country by country. We have a set of countries here. I think you can recognize most of them by their names. Here's Finland, where the change in production, was 0.7 here. That means it was 70% of the pre-recession period. So in Finland, manufacturing production fell by 30%, and imports fell by about 30%. And in countries where the recession was, the decline in manufacturing production was less severe, so was the decline in imports. So there seemed to be a big correlation across countries in these two things. And we've also, the red here are durables, the blue are semi-durables. So we've separated manufacturing into these two components. And you can see that the action was much bigger in the durable component than in the semi-durable component. So there was this big contraction in imports of durables and production of durables, less so in semi-durables. This is just turning to the recovery, so pointing to the opposite phenomenon now. This is looking from 2011, quarter 1, over 2009, quarter 2, and you can see again that much more of the action is there in these durables. This is a set of observations. Some may seem surprising, some may not seem less surprising. Our challenge, I think the challenge here is to try to think about what kind of general equilibrium model can we use to capture what's going on. As trade economists, we like to work and think about things in terms of general equilibrium. We're used to modeling the cross-section of trade, but here we're looking at some quite high-frequency time series properties, and we'd like our trade models still to work, but we'd like to integrate them with a phenomenon that's connected or is able to explain what's going on on the macro side of things. A quotation that at the time I thought was useful for us. This is from Rahm Emanuel, who's now the mayor of Chicago, but was advising, I think was chief of staff for Obama at the time. And this has been quoted quite a bit. Rahm said, "You never want a serious crisis to go to waste. It gives you an opportunity to do things that you think you could not do before." For economists, we should always be looking for events which create data, or where there's a lot of movement in the data, because it helps us uncover relationships that may be obscured in calmer times. And part of our motivation here was to exploit this period of the recession to try to learn about some parameters or some connections that might be harder to discern in less turbulent times. So the challenge here, I think, for economics is to take static models of international trade, which usually are applied to the cross-section, and make some connection with a dynamic model, macroeconomic model, which necessarily here has to be a multi-country one. What are the payoffs to this? Well, one, I think, is purely in terms of data. Trade data are good. The governments collect them administratively. They're collected through customs transactions. They're fairly accurate. They're fairly timely. That is, they're available fairly quickly. So policymakers can get a sense of what's going on with trade data very quickly. And they're quite detailed. The problem is it's not clear what kind of models we have to make sense of the trade data. What can they tell us? And then having done that, what the trade data allow us to do is see what types of shocks are hitting the world economy, where are they coming from, and how are they getting propagated around the world through the trading system. So turning to our framework, it builds on a number of literatures. I think a very important paper that was very inspirational to us was the Obstfeld and Rogoff 6 Puzzles paper, which I think poses a number of challenges to both international macroeconomists and trade economists. Sam and I, with Robert Deacle, had done some analysis of looking at macroeconomic shocks in terms of a gravity model, but the analysis there was all static, but we're going to build on that. I think a very important paper is Duran Fitzgerald's paper looking at financial market completeness, and her work was very helpful to us. And her work builds on Arrow, Arrow-Debreu securities, and a way of thinking about macroeconomic fluctuations that we're going to be building on. A couple of other papers that should be mentioned, Stockman and Tessar, we're going to find demand shocks are going to be important. And that was something that Stockman and Tessar realized in an international macroeconomic context were very important. To understand international business cycle relationships really requires, and in terms of a standard real business cycle model, is hard to do without introducing shocks to intertemporal demand. Also important here, the role of durables. Marianne Baxter early on wrote a paper recognizing their importance for macroeconomic fluctuations. I'm just going quickly to go through the model. It's a complex thing. I don't have time, and you don't have the patience to go through the details of it, but I want to at least explain and show you a little bit of the structure. I'm going to show you the equations. I'm not going to try to explain them term by term. I was just at a conference where someone tried to talk through a model. Nobody in the audience understood what he was saying. Then the discussant came up and put the model on a set of slides. She didn't have time to explain them, but people said, oh, now I see what the model was about. So rather than try to spare you the equations, I'm going to show them to you, and you'll probably see what's going on, but I'm not going to try to talk you through them. Okay, so real economy, we're going to assume perfect competition and complete markets. We want to focus on the real side. We're not arguing that competition is perfect or that markets are complete, but we want to isolate the role of the trading system in what was going on, and we didn't want to have that interact with some other types of market imperfections that might then be playing a role. There's going to be the model can be explained in two components, a static one, and any type period, which we actually describe as a state of nature. There's going to be a static equilibrium that's determining prices, wages, outputs, and trade flows. And then the static model is going to be embedded in a dynamic model where there are intertemporal decisions about spending and investment. Um, the static model is Ricardian. The primitive factor of production is just labor, which we're treating as homogeneous. Each country I has some endowment in any period, in any state S of T. I left the I subscript off there. As in the standard Ricardian model, workers can move across sectors, but they don't change countries. We also have capital, but it's an accumulated factor of production. In fact, we have several types of capital. We have 4 sectors: durable manufacturers, semi-durable manufacturers, DS, construction. Construction was a big player in the recession, so that's going to be a component. And then we have everything else, residual, which I'll often call services, but R for residual. Consumers, there's the residual stuff, the R, they just consume the flow of the residual stuff, the services. But then for the other goods, the semi-durables, the durables, and construction, their utility is from consuming the stocks of those things, not the flows. So even for semi-durables, our clothing, you consume a stock that you've accumulated over time. And that's how we're thinking of those. And of course, we're going to have much higher depreciation rates for semi-durables and for durables. We're going to have even lower depreciation rates for construction than for durables. But the period utility function is just Cobb-Douglas, and the flow of services are residual, and the stocks of those other things. Production side, the durables and semi-durables are produced, that is, the investment in those is produced with a continuum of differentiated goods, indexed from 0 to 1. Countries have efficiencies for making each of those points on the continuum drawn from a Fouché distribution with parameters here, T and A. It looks kind of messy because we have the states of nature. That this is the Fouché distribution. Construction and services are, C and R, are just produced with labor. We're not introducing differentiation there. I'm not going to show you the details, but we have inter-industry linkages across all of these in Cobb-Douglas forms. Trade, we're going to focus on trade and manufacturers. We're consequently going to treat the non-manufacturing trade deficit, which tends to be fairly small, as exogenous. For our manufacturers, they're going to be iceberg trade costs of the normal type. We're also going to assume that once manufacturers are invested in capital, they're immobile. You don't rent clothing from somebody in another country. The static model then is going to have an equilibrium that determines wages, the value of the capital stock, the rental value, the price of each manufactured good, the price indices, the prices of construction and the residual thing in each country. So it's a big general equilibrium system. It looks it has a lot of notation on it, but this part in principle is fairly straightforward and is easy to solve on the computer. Following Alvarez and Lucas, we use world income as the numeraire. Another thing we're going to take as affecting each period is what do people think capital is going to be worth in the future? So here, there's going to be a value of capital in the continuation state. There's some discount factor that's applied to that. We have different continuation states, and that's going to be how we perceive the value of putting a piece of capital aside today, what we call big Q in honor of Tobin's Q. Okay, so that's the static part of it. The dynamic part of it, we have an infinite horizon model with discrete time. For macroeconomists, I think this is very plain vanilla for a single economy. What we're doing is we have an arbitrary number of economies that are then connected by these gravity trade flows. We have these states of nature. The authors had fun going back to reading Arrow again and learning how Arrow very cleverly modeled at the intertemporal equilibrium with uncertainty in terms of states of nature. There's some probability from the beginning of time of each state of nature in the future. Intertemporal preferences, people have the discount factor. Remember, this capital U is flow utility. Then they're maximizing the expected value of flow utility for forever. This is the probability discount factor. This phi is this intertemporal preference shock of the sort that Stockman and Tessar introduced. That sometimes there are periods when countries want to consume a lot and periods when they don't. That's a country-specific parameter. There's also capital accumulation, which again is kind of standard. We have depreciation and then investment, but a Hayashi-type investment function where there are diminishing returns to investment, which seems to be very important in macro models and capturing the data. There's some initial capital stock. We can then talk about a dynamic equilibrium where the firms or investors are maximizing the value of capital through their investment decisions. Households are maximizing intertemporal utility. This is all they're spending forever given their initial endowments of capital, future labor earnings, and the net foreign asset position from the beginning. So this is all kind of standard, but I just wanted people to see the ingredients. You can solve the model. We solve it in terms of changes, and then we take the model to the data. And this is where the model, as you can say, there's a lot of things in it, but it's taking, I think, fairly well-known ingredients and combining them. And what it's going to do is we're going to go back to the data, and we're going to look at 6 sets of observable outcomes and connect them to 6 sets of shocks, of exogenous shocks to the economy. And the 6 equilibrium outcomes we're going to look at are the trade shares and manufacturers, those things that we saw fell so much. Okay, these are equilibrium outcomes. We're going to look at the price of manufacturing outcomes. We're going to look at the consumption demand for services, investment demand. For us, that's spending on manufacturers largely, or on construction. And that's what we saw plummet so much. We're going to look at wages and rental prices. But the key thing that we're looking at, the things we're looking at, the collapse of trade, those pies, the trade shares, and also the collapse in manufacturing production, particularly durable. So these are equilibrium outcomes that we see in the data. We're going to use the model to relate them to 6 sets of shocks. Changes in trade barriers, the Ds, the DNIs, the iceberg trade costs. Now, if there was a problem with trade credit, those went up. Trade credit got more expensive. Macroeconomists talk a lot about productivity shocks. We're going to have those here. How much can a worker produce? We're going to have this sort of unusual shock, which is the shock to the value of capital in the future, the Tobin's Q shock, for the 3 types of capital: durables, semi-durable manufacturers, and structures and construction. We're going to have these demand shocks, and we have to normalize them relative to a world demand shock. We're going to have shocks to employment. We don't have a theory of unemployment here, but we're going to match what happened in the data. And I mentioned we have to worry about non-manufacturing deficits. They're there in the data. We don't have a theory of them, and we're treating them as exogenous, as if the planner had just dictated them. So I'm not going to show you the 6 sets of equations that connect these shocks to these outcomes. They're in the paper. But what we're going to do is take the model to the data, and we have quarterly data from 20 countries, and we've turned the rest of the other countries into a rest of world. We have data on production, bilateral trade, price indices, and employment over around the last 10 years. The coverage is a little uneven, but we've covered the recession, the period of the recession and recovery. There are a bunch of parameters we need to calibrate. These are the countries in our sample with some summary statistics. Um, Now, we have these shocks. We can go to, our model says we can go to data, things we can measure on the right-hand side, like trade shares and price indices. And the model says they're going to connect to what's going on with the Ds, the iceberg costs, things we can't directly measure. Similarly with productivity, this shock to demand we can get a handle on by looking at expenditures on other stuff, on the residual, on services. We can back out the value of capital from what we see people invest, kind of backing, we're sort of reversing the investment equation and solving for the Q that must have been there given the investment that was taking place, conditioning on other things like prices and the capital stuff. We can measure a couple of these things directly. We can look at the data to see what happened with labor. We can look at the data to see what's happening with non-manufacturing trade deficits. So that's that's the exercise we went to. We're using the model as a measurement device or counting device so that we can go to the data and back out these shocks. Now, together, if you ask us, how well do your shocks explain the data? The answer is, of course, they explain it perfectly by design, because the shocks were backed out from the data. So there's no error there in any sense. It's a just identifying system. So what good is that if your model is tautologically explaining everything that happened? Well, for us, the answer is we can then go back and say, all right, here's the world with all of our shocks. Then that's going to be where we are. But then we can go to the other end and say, here's the world with none of our shocks, and the slight wrinkle having to do with investment, that's the world where nothing changed from the previous period. But then what's interesting is the exercise in between, where we can ask, well, between nothing happening and what actually happened, what types of shocks contributing to the change that occurred? We can look at them individually. And I'm going to go back to that picture that I showed you at the beginning. This is world trade to GDP, and this is just repeating that. But what we're going to do now is ask, well, what if only certain types of shocks have been operating in the world? And the first, one of the hypotheses is it got harder to trade. In terms of our model, that meant the Ds went up. Iceberg trade costs got bigger. And we can ask, well, how much from nothing, which would be being at the point at the peak there, how much of that decline could be explained by what was happening to the iceberg trade costs we backed out? And there's the answer, virtually nothing. If the only thing that had gone on had to do with iceberg trade costs, there would have been a little blip, but not with the recession slightly late, and then iceberg trade costs seem to continue to have gone down, much as they did in the previous period. All of these lines are going to go from the beginning of the recession. Okay, that's the iceberg trade costs, and you see they're just not doing very much. We have all these other things here. We have idiosyncratic demand shocks. We have value of structure shocks. We have service deficits. You can see there we plotted out how much they would have contributed to the collapse of trade, and the answer is pretty much nothing. So where does the action come from? It comes mainly from the value of durables, the Tobin's cube type of thing. That's what we wanted. We saw this decline in investment that the model can explain only in terms of what people anticipated the future value of durables and semi-durables was going that these capital shocks seem to be, value capital or tokens Q shocks seem to be what's behind things. You don't see it here, but productivity shocks just don't seem to be playing any role there. We didn't even bother to create a slide for them because they just don't do enough. This is looking, comparing recession and pre-recession for the world as a whole. We can also look at the extent to which differences in countries' experiences were driven by different factors. So the recession hit different countries in very different ways. Some countries were hit much less than others. But here we're looking at, well, if we ask what was driving the cross-country differences, well, it was largely where the value of manufacturing capital shocks were hitting most severely, that trade fell the most. That's in the the northeast quadrant there. The trade friction shocks weren't very important for cross-country differences, nor were these other types of shocks very important. So, as I say, the world trade seemed to fall because of world decline in tokens Q. The cross countries, where tokens Q declined more is where trade declined more. This is looking at the same question in cross-country differences, what was happening to manufacturing production. By the way, just to see, you can see there, for instance, there were two countries in our sample where manufacturing production actually rose during the recession. They were India and China. Other countries then were all experienced a decline, largely because of changes in the value of capital. Trade friction shocks were doing a little bit of work as well in explaining some of the cross-section variation. So was there any, what about relative GDPs? Now here things are quite different. Here the various shocks seem to be playing a role, but the most important one for relative GDPs seem to be these idiosyncratic demand shocks. And a little bit also the value of structured shocks here. It doesn't show up that well, but where there were collapses in housing construction were also countries that experienced a big shrinkage of their GDP. I think Spain in particular. It's a little hard to see there. We can also ask, where did the shocks come from? Okay, this is by type of shock, but we can also ask about origin of shock. And the picture here is very mixed. The question we're asking here is, instead of decomposing the change for each country according to the nature of the shocks, we're decomposing the change according to where the shocks come from, and in given limited space, we're saying, let's consider all the shocks where this country was involved, where France, we're looking at what happened in France, to what extent were French shocks driving what happened, to what extent were shocks not involving France affecting what was happening to France. And that would mean through the general equilibrium of the trading system, say shocks maybe to Germany or to China or to the US were affecting France, even though the shocks specific to France weren't doing anything. And the picture is very mixed here, that that foreign and domestic shocks seem to be playing an equal role for most countries. If we look specifically at certain countries, some shocks are playing a bigger role than others. Maybe I should have just explained, I'm nearly done, but just explain exactly how to interpret this. Here's the change that happened in the data. Here's the change that happened because of certain types of shocks. If those shocks perfectly explain the data, we're on the 45-degree line. If they don't